Start the recording. So hi everyone. I first of all I want to thank David and the firm for just mentoring with us, sharing the knowledge to a small business community in San Antonio. And if anybody's joining from outside San Antonio, welcome to the session. Today we're going to be kind of talking about understanding the small business taxes. We are in tax season, so this is a great time to be thinking about it. And also, if you have specific questions, you're welcome to share them with us in the chat or raise your hand and unmute yourself and ask the question. For those watching on Facebook, you can also do that, share in the chat, and I'll make sure to put this just kind of ask those questions in the Zoom. So thank you, David. And whenever you're ready, we can get started.
All right, thank you very much. Appreciate everybody being here this morning. Like she said, if you got questions, raise your hand. I think we've got plenty of time to answer the questions as we go. And if we'll also save some time at the end, if you have some, if you don't want to ask your question right now, just write it down and we'll make sure we get everything covered in the end. Anyway, my name is David Plemons and I have a CPA firm here in San Antonio. Our focus is primarily on the small business community. Therefore, this small business taxation is somewhat near and dear to our heart just because this is what we do every day. This is how we help people. And we've been doing this for coming up on 25 years. So I think that makes me about 35 years old if you're doing the math on that. If you're not doing the math, just trust me. Hopefully this will be beneficial to you. That like I said, we've a lot of how these things go sometimes relates to the feedback, and I enjoyed them quite a bit when we were able to do them live, and hopefully we'll get back to doing those live things again. But these Zoom things are sure easy and they do work well. So let's talk about small business taxes, how things work. You know, different entities are taxed in different ways with different tax rates and all kinds of things. And I want to make sure we give you guys some kind of a basis in that so that you can make good decisions going forward. So obviously the first thing we have to do is make our disclaimers, as everything we're doing is not giving specific tax advice. We're just talking in general about the rules. If you want any specific advice, then we need to get into specific circumstances. So for example, if two people we're talking to, we could give the same advice to one and it'd be good advice to one and bad advice to the other one, just depending on the circumstances. So we have to put that in there so you don't sue me. What we're going to do primarily is we're going to talk about the different business organizations, the sole proprietor partnerships, corporations, how they're taxed, what the forms they have to file, what they have to worry about, what they don't. We're going to talk about bookkeeping systems, record keeping. And most people, you'd be surprised how many people come to us and say, we don't even know how to keep the records. What do we need to do? We started a business or we're fixing to. What do we need to do? So we'll talk about that. Record keeping in this term, we're talking about how long do you keep something? We get that question a lot. I did this. How many years do I have to keep it? Well, it's like as long as you think you need to keep it plus 10 years, but I'm joking. We will tell you a little bit about how long you need to keep your stuff. Information returns are 1099s. A lot of small businesses get out there and go, I don't even know what that means. How do I know if I'm supposed to send them out? If you don't send them out, there's penalties from the IRS. So we're going to talk about some of those rules. Then we're going to talk about something called a franchise tax, which is a state-specific tax to the state of Texas. And then something called a personal property tax, which is a county level thing. So if you're here in San Antonio, this is the Bexar County Appraisal District. That's who you deal with on your personal property tax. So a lot of fun, exciting things. There are no big cash prizes like you see on TV. Nobody's going to win a car. I'm not going to give away a car, but hopefully we'll do something that'll help you out. So the different types of business organizations we're going to talk about, obviously this doesn't cover everything that's out there. We're not really going to talk about nonprofits because that's a whole nother subject, a whole nother realm all its own. But we're going to talk about a sole proprietorship, what it is, how it works, general partnerships, limited partnerships, C corporations, which are the ones that have been around forever, S corporations. Everybody wants to be an S corp, but not everybody knows why. So we'll talk a little bit about that. And then this wonderful, wonderful thing called a limited liability company that everybody also wants to be, plus they want to be an S corp. And we'll talk about what's the big hubbub? Why does everybody want to do that? And why are all your neighbors LLCs when you may not even know about them yet? So we'll do what we can to help make it clear. Sometimes clearing up a little bit of the mud helps. Sometimes you have to sit through and hear things 3 or 4 times. At least I do, for the water to clear up. So hopefully we'll do a good enough job that you know what we're doing here. All right, there's something called a sole proprietor. And I'm pretty sure you've heard the terminology before. What a sole proprietor is just one person who goes into business, and there's nothing formal. I mean, literally you could stand out on the street corner and say, I am in business, I'm selling ice cream. And you are a sole proprietor. That's all you have to do. There's no legal paperwork, there's no nothing. Now you got some tax issues, like I say, to worry about, but creating the entity itself, all you got to do is say or decide, you don't even have to say it out loud, just decide in your mind, I want to be in business, therefore I am a sole proprietor. Now, a sole proprietor is what's called a disregarded entity from the IRS. The sole proprietor is treated as the taxpayer. So if you're a sole proprietor and you want to take care of your personal tax filings, the sole proprietor files a Schedule C if you're running a business, or you could actually be a farmer. You could have said, instead of saying, I'm going to sell ice cream, you could have said, I'm going to be a farmer. Farmer scale or a rancher files a Schedule F as in farm. These schedules go on your personal tax return. So if you guys are used to preparing your own tax returns, you do your 1040, you're going to attach a Schedule C or a Schedule F, whichever one applies to you as a sole proprietor. Basically, that schedule, what it is just a profit and loss statement for your business, which you stood on the street corner and created. So what are your sales? What are your expenses? Gives you several categories. To put your expenses in, here's what your profit is at the bottom line. That transfers to the front page of your 1040, gets added to your taxable income or subtracted from, because a lot of times you're going to lose money as a sole proprietor, especially in the first year or two in the startup years. You will most likely lose money, so be prepared before you stand on the street corner and make that pronouncement. One thing that's fun and wonderful and people don't think about because they don't know about it, but they get really excited, is something called self-employment tax. When you work for a company and you look at your paycheck, you'll notice they deduct Social Security and they deduct Medicare tax out of your paycheck. Every time you get a paycheck, there's a deduction coming out. What you don't see is that the company matches that. So if they take $100 out of your paycheck, the company puts another $100 in, and then the company sends $200 into the Social Security Administration. That's where it ends up. They send it to the IRS, but ends up with Social Security, gets credited to your account, et cetera, for when you want to retire. Well, when you quit your job and you went out on the street corner and you said, okay, I want to sell ice cream, or I'm going to be a farmer, or whatever you're going to do, all of a sudden you don't have a paycheck anymore. And nobody's paying in Social Security Medicare tax for you. So guess what? The IRS says, I don't care. I still want Social Security Medicare tax. on your earnings. So they've created something called a self-employment tax, which is primarily Social Security, Medicare for self-employed individuals. The kicker is it's 15.3%, which is a lot of money, but it's only of the profit. So if you look at your Schedule C, you go all the way down to the bottom and look at that profit number. Like I said, the first couple of years, generally that's not a profit. It's going to be a loss just because it takes a while to build up customers and all kinds of stuff. But from then on out, once you start making a profit, you're going to be paying, in addition to the income tax. So you may pay 10, 15% income tax, plus you may pay another 10, 15% self-employment tax. So you're up at a 25, 30% tax rate fairly quickly. So people get surprised by that quite often. The people we work with, we try to make sure you know this is coming, and we talk about estimated payments and different things, which we really don't have time. We can talk about them at the end if we have time. When do you make estimated payments? When do you not have to? Because the IRS wants your tax money in on a consistent basis. So when you're working for a big company, they take money out of your paycheck, they withhold taxes, they turn around and send it to the IRS, either monthly, weekly, whatever payment schedule they're on. As a sole proprietor, you don't have that. So there's ways to pay your taxes in quarterly. And like I said, if we have time at the end, we'll look at that. You need to look at what you're doing. If you went out and said, I'm selling ice cream, then you need to worry about something called sales tax. All of you guys know what sales tax is. You know what it works. You go to the store, you buy something, it's $4 plus sales tax. So you end up paying, $4.50 or whatever the math is. When you're in business, you're selling something, you have to collect that sales tax if you're performing or doing something that's taxable. So for example, if you're selling professional services, if you're an attorney, if you're a CPA, if you're an engineer, you don't charge sales tax on those because they're considered professional services and exempt from sales tax. But if you're selling a product, you're selling ice cream, you're selling lumber, whatever it might be, or you're selling clothes, you're going to need to register with the state. Texas State Comptroller is where you go to register. You can go to their website, you can register online, but you need to do that pretty daggum quick because you need to be collecting the sales tax and remitting it in to the state. As a sole proprietor, you don't have to worry about franchise tax. Consider that on the side. We'll get to that towards the end as far as how that actually works. But you may or may not really need to worry about the personal property tax with the county. I mean, if you're working out of your house and all you've got is a computer, the personal property tax is no big deal. And we'll show you how it works at the end. But if you're in any kind of industry that has equipment, machinery equipment, inventory, et cetera, the personal property tax can run up to be a pretty daggum big number. We work with some trucking companies. Some of our clients are trucking companies, and you take every single truck that they have has to go pay personal property tax every year, and they're paying $50,000 to $100,000 just in personal property tax. So it does add up in a hurry. There's a lot of taxes to watch for. But anyway, this is what a sole proprietor is. You walk out on the street corner, I'm in business. If you're done, if you're tired, you don't want to do it anymore, you go back to the street corner. It doesn't even have to be the same street corner. It could be the next one over and say, I'm done, I quit, I'm out of business. You can start and stop a sole proprietor that quick. I would caution you, if you do go out of business, you got to go close the sales tax account. You got to close your franchise account. You don't have franchises there, but all of the accounts that you've opened with tax agencies, let's say you have employees, all of those accounts have to be closed out. And people seem to forget that exiting a business can be expensive because you either got to close all these things or pay somebody to close them out. for you. And if you don't close them out, the state likes to contact you, or the IRS likes to contact you and said, we missed you, where'd you go? Come back, we're going to help you. And that's not always a good thing when they say they're going to help you. Anyway, excuse me, that's a sole proprietor. Next one, something called a general partner. And before I get talking about this, let's go one more thing on sole proprietor I forgot, is a legal liability issue. And if you're not quite sure, speak with an attorney, ask them to explain it to you. But as a sole proprietor, you have no legal protection that separates your business from your personal life. Like we said, you just walk out on the street corner, you claim I'm in business. Nobody built a legal wall around that business at all. So if you're sitting over here and you inherited grandma's diamonds and jewelry and cars and a big, huge house from grandma, and your sole proprietorship does something really, really bad. Let's say you're selling ice cream. The ice cream got tainted. People started getting sick all over the place. They're going to sue you as the ice cream person. And all of the stuff that your grandmother left you, all of those assets are subject to being taken away from you as part of this lawsuit. So there is no liability protection with a sole proprietor. So please be careful. And we'll talk a little bit more about that. Okay, general partnership is basically a sole proprietorship, but with two or more individuals. So as sole proprietor, you went down on the street corner and you said, all right, I want to start an ice cream business. Well, if there's two of us, if you and I both go down to the street corner and we're in business selling ice cream, we just created a general partnership. A lot of the rules are same as sole proprietor. Generally, you don't have to worry about the state franchise tax. And when you think about state franchise tax, think about, is there any legal protection for this entity? If the answer is yes, you're probably going to be subject to franchise. If the answer is no, you're probably not. But a general partnership is generally not subject to that. Yes, on the personal property tax, same as sole proprietor. Every single entity we talk about is going to be yes on the personal property tax. Sales tax, maybe, maybe not, depending on what we're doing. But if we're selling ice cream, you know, maybe we got two rolling carts. You got one street corner, I got the next street corner. We're still a partnership. We're still going to be collecting sales tax. That sales tax account would be titled and registered under the partnership, not under us personally. Generally, in a general partnership, any income that we have is going to be subject to the self-employment tax, just like as a sole proprietor. The biggest difference between the two is I'm not one, but I'm two or more people, and the way the taxes are computed. As a sole proprietor, taxes go on your personal tax return on Schedule C, Schedule F, whatever. As a general partnership, we start to differentiate a little bit on the tax standpoint. The partnership's going to file its own unique separate tax return. The partnership's going to have a set of books. Those books are reflected on the partnership tax return. And let's say you and I, we started this thing, we're 50-50 partners, okay? And the partnership made $1,000 of profit. We did really good, $1,000 of profit, which basically allowed us to take our family out to a movie and buy the kids popcorn. That's about it. We used up our $1,000. But go back to we made $1,000 a piece. The partnership does not pay income tax. The partnership does not pay the self-employment tax. That still flows back to you as an individual on your personal tax return. So let's follow it through. The general partnership files a Form 1065, which is a partnership tax return. It shows on there $1,000 of taxable income or whatever it is. We're just using 1,000 for our discussion. You and I are 50-50 partners. So we each get $500 allocated to us, 50% of the 1,000, that we then have to pick up on our personal tax return. We pay income tax on it. We pay self-employment tax on it as part of our personal tax return. Not a lot of fun when we see a lot of people that create partnerships and they're used to filing their personal tax return, you know, at the get-go. Once the gate opens, they go ahead and file it, and then we go, but wait, you've got a partnership, you got to file those taxes, put them on your personal. So they have to go through it all again. We have to file the partnership and then go back and amend or make changes to the personal returns to get everything squared away. So if you've created a partnership of any kind or an entity of any kind, make sure the taxes are squared away on the entity first. Then they're going to, because they may or may not flow down to you depending on the type of entity, and we'll kind of cover some the ones you don't need to worry about. So anyway, that's how that works. And you remember the discussion we had on the sole proprietor as far as the legal liability. Okay, a general partnership is legal liability of a sole proprietor on steroids. So you and I are 50-50 partners. You inherited all this stuff from grandma. The partnership did something wrong. And it may have been my fault. It may not even have been your fault, but the partnership is now liable for something. There is no legal protection for you. Now, for my mistake, your grandma's stuff can go away. I mean, and I'm sure there's ways lawyers fight that and say, you know, whatever, but I'm just giving very, very general stuff here. General partnership is not something we recommend. It's pretty rare that we will actually recommend that somebody set up a general partnership with no legal protection. Generally, it's a mistake. So, and you have to watch, because sometimes you'll enter into a partnership without even realizing it. It's like you and I are hanging around doing something. We say, hey, let's get an ice cream thing. Let's start selling ice cream. Like, you know, we talk this thing up, and then we go do it without even thinking about anything. But we've created a partnership just by putting ourselves together, selling ice cream together, and all that kind of stuff. So you kind of have to be careful that you don't accidentally fall into a partnership. Okay, general partnership, we generally don't recommend it, but you see how it works. And what we're going to talk about next just starts to kind of build on this. Then there's something called a limited partnership. Now we're into the realm of liability protection. We're into the realm of filing documents with the Secretary of State to actually create these legal entities. The sole proprietor general partnership, we stood up on the street corner and just said, hey, we're in business. No longer, from everything else we're going to talk about from here on out, you can't do that. You've got to file paperwork with the Texas Secretary of State or any state that you want to register. We have people go away to Nevada and they'll go to seminars and they'll come back registered in the state of Nevada as some kind of an entity. And we're going, why'd you do that? Well, I went to the seminar and they said it was a great deal. I digress a little bit, but it's fun. What happens if they register in Nevada, that means they can operate in Nevada. If they want to operate in Texas as part of that Nevada entity, then they need to register in Texas as what's called a foreign corporation. So a Nevada corporation operating in Texas has to be registered in Texas with the Secretary of State. And then there's, I believe, a $750 fee you have to pay. So when you go to Nevada, be careful, or Wyoming. We see it a lot in different states, but I've been told by attorneys, I'm not an attorney, so I'm not giving you legal advice. I've been told by attorneys that Texas is a very good place to create your entities in general, and they don't seem to worry about registering in other states. And primarily it's a legal issues. What laws do you want to operate under, that kind of stuff. And I don't 100% understand all that. I'll let the lawyers deal in that. Anyway, a limited partnership is something you create with the state of Texas, file with the Texas Secretary of State. You have to have what's called a general partner. Obviously, a limited partnership means it's going to have partners. You got to have a general partner that owns at least 1%. That general partner is the one that can get sued. They're the one that are subject to legal liability. They're the ones that run the thing. They make all the management decisions and all that kind of stuff. Generally, we will make them an LLC or something to help in the liability protection. But the other partners are called limited partners. They're just primarily investors. And you'll see limited partnerships. If you see a building going up sometimes, sometimes they're funded by limited partnerships. We could create a limited partnership to build and manage a building, office building, let's say. The limited partners just chunk in money. They go, yeah, I think what you're doing is great. I think we'll make a lot of money in the long run. Here's $10,000. And they chunk their $10,000 in, and hopefully we have a lot of 10,000s if we're going to build a, multi-gajillion-dollar building. But those limited partners don't have any liability other than they could lose what they put in. So if a limited partner puts in 10,000, the whole thing goes bust, the building falls down, everything gets sued, the limited partner's fine. They're not actively involved. They were purely just an investor. They can lose their 10,000, their contribution, that's it. The general partner's in trouble, but that's why we create entities and handle it a different way. But typically we don't recommend limited partnerships. There's other ways to get the liability. Limited partnerships, before the LLCs became so popular, limited partnerships were more, in my opinion, they were more popular. And we create them here and there, not too often. But I don't want you to get hung up on wanting to be one, because probably you don't need to be. But if you're interested, give us a call and we can sit down and talk about them.
There's a question in the chat. It says, what about Delaware?
What about Delaware? Was that the question?
Yeah, that's the whole question.
Okay. A lot of companies register in Delaware, and it's generally nationwide. Your big companies register and create their corporations in Delaware because the state of Delaware laws relating to corporations is more corporate friendly than it is in a lot of states. So you're going to see a lot of your big companies. We have a lot of our international companies that operate in the U.S. create their U.S. entities in the state of Delaware. Even if you create it in Delaware and you want to operate in Texas, you still need to register in Texas as that foreign corporation. There's nothing wrong with registering in Delaware or registering in another state. It's just you got to register also in Texas as a foreign corporation if you're going to operate in Texas. If you register in Delaware, you got an annual franchise tax you have to pay each year. And in Delaware, it's based on the number of shares of stock. So you got to be really careful, because a lot of small companies will come in and say, you know what, I want to authorize 1 million shares of stock. That way I'll have them, I can sell them. Delaware goes, yeah, boy, because they tax you on how many shares of stock you've got. So you want to keep the number of shares small, or you're going to pay Delaware a lot of money. But that's a very good question. Okay. Limited partnership, I think we're done. Well, one more thing. They file the same 1065 as a general partnership. There's just a box you check. Is this a general or limited partnership? Otherwise, the forms are the same. All of the partners get a Schedule K-1, which distributes the income. Even the limited partners will get one. So if you've invested as a limited partner in a limited partnership, you have to wait till you get the K-1, Schedule K-1, before you can file your personal taxes. General partner, depending on what the partnership's doing, may be subject to self-employment tax. Limited partners are generally not. If if the self-employment tax concept interests you, we're doing on March the 18th. I'm just going to sit here and plug something real quick. A Financial Friday. We do Financial Fridays for Launch SA at 10 o'clock on Fridays. On March the 18th, we're going to be talking about subchapter S corporations and self-employment tax. We'll spend an entire hour just talking about that one subject, which allows us to dive a little deeper than what we can today. All right. The next thing is a C corporation, and C corporations are the ones that have been around forever, long time, more than a week or two. This is the only entity that we're going to talk about that pays its own income tax. So the limited partnerships pass through income or loss with a K-1. General partnership does too. So proprietor, you know, they're paid on the personal return. LLCs, maybe not. We'll get to those in a minute because they're pretty flexible. But a C corporation pays its own income tax. This is the only one we're going to talk about that does that. Right now, that tax rate is 21%. Up until 3 or 4 years ago, the tax rate was 34%. That made for small business, it just didn't make a lot of sense to create an entity that you know is going to be taxed at 34%, where maybe as a sole proprietor or one of these other entities, it would be at a lesser tax rate. When the taxes changed, and all the years run together, but I think it's been 3 or 4 years ago, we had that big tax change. That corporate rate was dropped to 21%. And all of a sudden, everybody is now looking at ways to tax plan using a 21% tax rate instead of 34. Because a lot of us on our personal returns are higher than the 21% rate. So how can we use the C Corp to help us out? So there's tax planning stuff to be done in there. The question of the day is all Congress has to do is say that rate's too low and they can raise it. There's been discussion in the suggested tax updates that rate go to 28%. Early on, when the President Biden and his people came in, they were talking about 28%. The last thing they did in the Build Back Better, they really did not. They left it at the 21. So right now it's 21 and it will stay at 21 unless somebody changes it. But it's one of those, if you do tax plan using the 21% rate, keep in mind it might change. It is subject to state franchise, local county property tax, maybe not on the sales tax. All of these are the same in that regard. It does file its own separate tax return, a Form 1120. And on that return is where you calculate the tax. The corporation has to pay the tax in. It does not distribute to the owners at all. And it's subject to something called double taxation. A lot of you have heard that, but not a lot of people know what it means. A C corporation is fairly well locked up as far as the money. The availability to take money out of a C corporation is less than an SCorp partnership. Some of those you can just take money out. C corporation, you really can't. So one of the ways they distribute money and keep their shareholders happy is something called dividends. And if you guys own shares in any big company, you're probably familiar with the fact that these companies pay dividends. You get a 1099 DIV form. At the end of the year, you get to pay tax on that. Well, the double taxation comes from the C corporations. When they pay dividends, they cannot deduct those taxes. They cannot deduct the dividends from their taxes. So the corporations have paid a 21% tax on those dividends by the fact that they cannot deduct them. The dividends then show up to you as a shareholder on a 1099 DIV form. You have to pick that up and you pay income tax on the dividends. So Corporation ends up paying tax on the dividends because they can't deduct them. The individual pays tax on the dividends, therefore the double taxation. Now you guys can run around, tell everybody you know what that means, explain it to them, pretend like you're real smart, and they will think you're real smart, and then maybe they'll buy you something. Anyway, that's a C Corp. Probably maybe a fourth of our businesses are C Corps that we work with. But by far the most popular are the S Corps and the LLCs, of which we're just now getting to those. Okay, then there's something called an S Corp, and a lot of people have heard of it. And what you hear is great. I want to be an S Corp. A lot of people don't know why. S Corps are good for some people, not good for other people. It's just like the advice that we said, 2 people in a room, S Corp may be the way to go for one, but not for the other. The S Corp is not a legal entity. So when we started with limited partnership has to register with the Texas or with the Secretary of State of whatever state you want to go for. C Corp has to register with the Secretary of State. An S Corp per se does not register as an entity. And here's where it's a little bit confusing. An S Corp is just a taxing election. I want to be taxed as an S Corp. In order to do that, you have to be a C Corp, an LLC, something that was created with the state as a different entity. So you have to create an entity with the state. Then you file some paperwork with the IRS and says, okay, guys, I now want to be taxed as an S Corp. But legal wise, if you ever get sued or issues with the state, you're still a C Corp, LLC, whatever that you created with the state. An S Corp files an 1120S. So again, it's got its own unique tax return, and all these tax form numbers are probably running around your head, making you crazy. Files an 1120S. It does not pay its own income tax. The C Corp was the only one. So an S Corp now is distributing back K1s again to the shareholders. So if you own part of an S Corp, you cannot file your personal income taxes until the Schedule K1 is received from the S Corp. If you do file your return, you'll have to go back and amend it once you do receive the K1. It's not subject to double taxation. I mean, you can force it to make it double subject to that, but you really don't want to. And there's some advantages due to the self-employment tax we really don't have time to go into. Maybe at the end, if we have time, we can talk about them a little bit. But the general thought process behind becoming an S Corp is so that we can save on the self-employment tax. And that's good on one hand, maybe not so good on the other hand, because we always say, all right, you want to be an S Corp, you want to save all this money. Someday you're going to want to retire and you're going to find out you hadn't put very much money in Social Security. I sure hope you've been saving money on the side. So those are some things you really need to think about. And those are the type of things we'll talk about more on March the 18th. S Corp is very popular. I am an S Corp. A lot of people I know are S Corps. They're good in certain circumstances, not so good in others, but generally it's a pretty good thing. You can go around your neighborhood and tell everybody what an S Corp is, and you're going to look even more impressive if you've explained double taxation and an S Corp. And then once we get done with LLCs, you can explain those. You are really going to be the highest big shot in the neighborhood. Okay, we saved this one to last because we kind of build on some of the other stuff. Well, LLC, everybody wants to be an LLC. People create them right and left. I promise you, and I challenge you to do this. Go down your neighborhood and knock on every door and ask people, are you an LLC or do you have an LLC? And I bet you a fourth to a half of the people will say, yes, I do. And then your job is to say why, because you're going to stump them, because a lot of people are not going to know why. They just so-and-so told me to, or whatever. They are very, very good. They're good at the legal protection side of things. I've had an attorney tell me that this is as close to bulletproof as you could get. Those are not my words. That came from an attorney that I trust. So it's probably a pretty good thing as far as the liability protection. Because it's registered with the Secretary of State, it's going to be subject to the franchise tax, local county property tax, sales tax, just like the rest of them. Here's where it gets interesting. The IRS does not have any tax forms for an LLC. So if you recall, we had a Schedule C for sole proprietors, a 1065 for partnerships, 1120 for CCorps, 1120S for SCorps. There is no form for an LLC. So because of that, there are certain defaults assigned to an LLC as far as how is this entity going to be taxed? We created an entity, and now how's it going to be taxed? If the LLC has one owner, then the entire LLC is taxed and treated just like a sole proprietor. It follows the same guidelines as a sole proprietor. An LLC in that regard is considered a disregarded entity from the IRS's standpoint. The IRS disregards the fact that you have an LLC and it sees it as a sole proprietor. The legal guys do not disregard the LLC. Super important from a legal standpoint, but from an IRS taxation standpoint, they see the taxpayer and the entity all as one thing. If there's more than one owner, you're not a sole proprietor, you're a partnership, okay? You're not a limited partnership, you're a general partnership as far as paper filing. So you would follow the rules of a general partnership. You'd file the Form 1065. Each owner would get a Schedule K1, which spreads the income or loss out to each of the partners. And the fun part of an LLC is if you don't want to be taxed in either one of those, then how do you want to be taxed? You get to tell the IRS how you want to be taxed. We have LLCs that are taxed as C Corps. They have reasons. There's some valid reasons. We have LLCs that are taxed as sole proprietors, as partnerships, as S Corps. You can pick and choose. I want to be, and a lot of people want to do the LLC, but I want to be taxed as an S Corp, and that's fine. It works great. If you ever change your mind, you can undo. You can stop being an S Corp if you want to. There's certain rules you have to follow to be an S Corp. If you violate those rules, whether on purpose or not, you cease being an S Corp, then you would default back. So if we created an LLC, told the IRS I want to be taxed as an S Corp, 5 years later, I don't want to be that anymore. I either notify the IRS or break the rules. I'm not going to be an S Corp anymore. Then I fall back to being a sole proprietor or whatever I was before I made the election for the S Corp. An LLC may or may not be subject to the 15.3 self-employment, depending on the status of the partners, if they're active, passive partners type things, and also what the entity does. Real estate does not generate active income or does not generate earned income for self-employment, but other things do. So you kind of have to look at what you're doing also. But LLC is good. So if there's any, you see these things on TV where you got a circle, red circle with a line through it, that might be a general partnership. You really don't want to be one of those from a liability standpoint. You may or may not want to be a sole proprietor from a liability standpoint. LLC, if you're doing anything serious in business, is probably a good way to do this. Now, I know there's ways to go create your own LLC, and we see this a lot. I highly recommend you go see an attorney and get it set up right. If you do it on your own, those of us who are not attorneys, Yes, you can file the paperwork with Secretary of State. That's pretty easy to do. But you need operating agreements. You need other paperwork that comes with this that is not coming from the state. That's what your attorney's going to bring to the table. You can get them LegalZoom, but I want to give you a couple of experiences we've had, more than a couple. People would do that, and then all of a sudden they figure out something happened that's not covered under that agreement. The agreements that you get are very generic and they're very bland. You know, let's say you get you two guys are partnerships. One of them, wife passes away. He marries another person. You know, all and that new one he married starts messing with the company, or he dies, the spouse takes over. Is that allowed? It's got to be, all that's got to be addressed in the operating agreements. If somebody gets hit by a bus, they're disabled, they can't work anymore. What happens? Are they still 50-50 partners, still draw half the pay? All that stuff's got to be addressed, and that's where your legal stuff works in, and I highly recommend you use them. So that's the end of my soapbox. I'll shut up. Okay. That's the entities. That was the fun part. Well, the rest of this is fun too. But let's talk about bookkeeping systems and accounting methods. When you do a set of books or a tax return, there's an accounting method. They're called a cash basis or accrual basis. 95% of the small businesses we work with are on the cash basis. What that means is it's income when I receive the money or when it's available to me. It's expense when I pay it. So if Joe Smith owes me $100,000, I don't have to show it as income until Joe Smith makes that money available to me. The other option is an accrual base, which means when I earn the money, that's when it's income. So I could invoice Joe Smith. I've earned $100,000. I invoice Joe Smith under the accrual method. I have to show it as income even before Joe Smith pays me. Most small businesses don't like paying tax on income that they have not received. It's generally not something people get excited about. The flip side of that is on the cash basis, you can't deduct it until you pay it. So if you bought you bought some ice cream, you couldn't deduct that ice cream until you paid for it. On the accrual basis, you could deduct it when you incurred the debt. So again, you're looking at economic things happening versus cash in, cash out. A lot of people, and if you use QuickBooks or something like that, there's buttons on there. You click cash button, click the accrual button, flip back and forth. Most of our, like I said, 95% of what the small businesses we work with on the tax return use the cash basis of accounting, just simpler. And it generally, you know, if you're making money, you're postponing some taxes. But on the book side, as far as your QuickBooks records, by keeping accounts receivable and accounts payable, that's considered accrual. You want to keep that so you know who owes you money, who you owe, all that's accrual books. But you can keep your books on accrual, do your tax returns on cash. That's totally fine. And it's easy to switch back and forth using the toggle buttons in QuickBooks or whatever program that you use. Once you select a message and method, and the way you select it is the first time you file a tax return for this entity. The first time you check cash accrual, there's a couple other options, but I don't recommend you use them. You check that, and then basically you're required to stay with that. So first year in business, I check, I'm going to do cash accounting. I stay with the cash accounting. Now, you can outgrow it. And, you know, when you get up into several $1 million worth of sales, I think the last they raised it to was 25 million. So once you get 25 million in sales, they force you back to the accrual just because it's considered more accurate. But anyway, other than that, just keep it on the cash. And if you want to change, if I've been doing accrual all along and I want to change to cash or whatever, you can't just arbitrarily go do it. You need IRS permission, and there's a form you need to file to do that. Here's where we get some really good, clear definitions from the IRS so we know what to include. Automated systems, whatever, if it's, it's QuickBooks, it's Wave, it's Peachtree, it's whatever is out there. The system must produce sufficient legible records to determine your correct tax liability. You can read that and you can interpret that. That's wide open. It could be subject to the auditor's discretion of how sufficient what you have is. One thing that I will tell you is you need a system. If you get audited and you have a QuickBooks or a Peachtree or a Wave or whatever it is, the first thing the IRS asks for is a copy of your system. They want to look at every transaction in the system, determine whether your system is being run adequately, and then they're going to randomly pick, oh, here's something, I need a copy of this. I need a copy of this specific transactions. Be prepared. Generally, audit of your business is not a lot of fun, but sooner or later, probably going to happen. It's not the end of the world if you're doing everything right. If your systems produce the legible records and whatnot, then you're probably going to come out fine. It's just a pain to have to go through it. Bookkeeping systems and methods, there's something called single entry and double entry. I do not recommend single entry if you are a business. Single entry is a checkbook, basically. It doesn't show debits and credits. It doesn't show debt, doesn't show anything. It just shows in and out. A double entry is going to track your assets, show your debits, credits, checks and balances. Like if you got loans and different things, it'll keep up with the balances. But I always recommend the double entry. QuickBooks, Sage, Wave, Cashew, pick one. They all work. Some are better at certain things than other, but most small businesses can pick any of those, and whichever one works for you, I would go ahead and use it. Here's some more fun IRS definitions. Records must be sufficient to substantiate items of income deductions and credits. What is that? Don't know. They must enable you to prepare complete and accurate tax returns. Okay, that's subject to our auditor discretion. Identify the source of the receipt and document the nature and business relationship of a deduction or credit. I want to throw something else out here while I'm throwing stuff out. A lot of people say, oh, you don't have to keep receipts. No, you don't. Do you want to pass an audit or not? What my experience with audits is, let's say you have on your business a lot of stuff that you bought from Walmart. Okay. Walmart, you could be buying a TV for you personally. You could be buying a TV for the business. You could buy groceries personally. You could buy office supplies. Okay. You could be buying furniture for the business. Walmart, HEB, some of these stores, just by seeing a charge on your credit card statement, oh, here, I bought, here's a charge to Walmart for $500. The auditor is going to go, what did you buy? They're not just going to take that. If you're in the construction industry and you're buying from Home Depot, they'll probably take it. My experience is, okay, I get it. Your construction, you go to Home Depot every morning, you buy your supplies for the day. I get it, I'm good. But when you get into situation, and Amazon's like that too, where you can buy multiple things, personal or business, the IRS auditor is going to want to show receipts. Show me that what you bought at Walmart is really for the business. And if you don't have a receipt, they can disallow it, and they very likely will for lack of proof. If you pull out a receipt that says groceries, you better be able to tie those groceries to the break room at your office. I would, and this is just me, but if I went and bought groceries and 90% of them belong to home and 10% of them belong to work, I'd run through the line twice. I'd say, okay, lady, or man, whoever the cashier, these are personals. I need a receipt for this. These are business. I want to run through a separate transaction and get a receipt for those. So no, you don't have to keep receipts, only if you want to pass an audit. So I would suggest that you keep them. You don't have to keep all the paper. You can scan them. They will take scan stuff all day long. So you don't have to keep piles and piles of papers, but you do need to keep document images somewhere. Okay, if you take somebody, customer out to eat, considered an entertainment or meals, entertainment is not deductible anymore at all. Meals have historically been deducted at 50% if they're business related. Entertainment was deductible up until a few years ago when we had the tax law changes. But for 2021, and it's fun when you know the rules only after the years are over sometime, you can deduct 100% of restaurant meals for 2021. They still need to be business oriented. If you're working, let's say in a building, you go next door and eat lunch every day. That's not a business meal. That's a personal meal. Business meals, you're bringing in a customer, you're bringing in a vendor, you're whatever, you're out of town. Those are business meals. Just buying your own lunch is not considered a business meal. But anyway, if you do take somebody, you need to take, I took Joe Smith, we discussed an upcoming proposal, you need to keep some kind of contemporaneous, whatever the word is, records to document that particular meeting. Okay, how long should you keep stuff? Here's where it gets, keep saying it gets fun, it never gets fun. The IRS has 3 years on a statute to audit you from the day you filed the tax return. So if I file my 2021 tax return today, March the, whatever it is, 8th, IRS has 3 years from today to audit that. If it gets to March the 9th, 3 years from now, it's too late. They can't audit me, okay? Generally, what happens is the IRS will audit you in that 3rd year. They're so far behind. So they're now doing like 2020 stuff right now, or 2019. They're going to come in 2 or 3 months before the deadline, and they're going to say, you know what? I'm going to disallow every single thing you've got unless you agree to extend your statute. They will back you in the corner, force you to extend your statute, which is the time period that this all expires, until the audit's done. My recommendation is not to chunk your stuff at the end of 3 years, but to wait at least 5 to 7 years when you're dealing with business type stuff. 5 years on your personal, I think is probably okay. Here's some exceptions though. If you got employees, your employment records, instead of 3 years, now they're 4 years from when due or paid. Records relating to the life of assets. Let's say you bought a building. You got to keep the records for that building until the building is disposed of, even if it's 50 years later, plus the statute on top of that. So some records you basically are going to be keeping forever, or if your kids are going to inherit the business, they're going to inherit the paperwork that documents some of that. You keep a change in accounting method. We talked about going from cash to accrual or whatever. Keep that indefinitely. And if you have non-deductible IRA contributions, which you can have traditional IRAs that are non-deductible for various reasons. And when you pull them out, the amount you pull out, part of it is tax-free because you never got to deduct the amount you went in, but you got to keep all that, be able to prove it. Okay. That's record keeping and all of that. This is something that we see it every single day, and we will go through this with people, and it's very difficult sometimes if we have a culture, as I'll just bring somebody in as a contractor because I don't want to mess with somebody being an employee. It's not that easy. There's rules you got to follow. If you want somebody to be a contractor, there are rules you got to follow. If you want them, or otherwise they're going to be an employee, and it's not your choice per se. you can build your case, you can set them up a certain way, but if the IRS comes in, they've got a I think it's 19-page questionnaire that they will go through. They'll go through it with you. They'll go through it with the potential employee and document the circumstances. Who did the training? Who provided the tools? Who did this? Who did that? You know, do you have to wear a company uniform? On and on and on. And the IRS will decide if these people are employees or not. So if you didn't think it through and work it from the get-go, you could be in trouble. And we've had people come in, claim people were contractors, they got audited. The IRS says, no, they're not. And by the way, here's $100,000, $200,000, $500,000, whatever it is, of penalties, not just taxes, but these are the penalties. Plus, you got to pay the taxes you should have paid in, the taxes you should have withheld from the employee. You can bankrupt yourself in a heartbeat in situations like that. So we came up with something. This is not official. This is something we came up with called the trick to try to help get this through. But the T is who provides the tools, okay? An employee will never provide their own tools. A contractor will. Okay, think about your air conditioner breaks. You call the air conditioner company, they come in, they bring skilled technicians who the company's provided all the training for. They bring their own tools, the Freon, everything. You just say, go out there and fix it, okay? They got the expertise. They know how to fix it, la-di-da. That sounds like a contractor. If you got somebody inside and you say, well, here's the tools to do this, here's the manual, whatever, and you start supervising these people, telling them what to do, it leans more towards an employee. And all of these things are not always black and white. There's a lot of gray in here. Risk, a contractor is going to take the risk of loss, an employee will not. So air conditioner guys show up and we say, all right, guys, what's it going to take to fix this? He says $1,000. You say, got it, do it. If it takes him $5,000, you don't care. You made an agreement with him. The contractor has the risk of loss on that because he put the price out there. An employee does not have a risk of loss. They get X per hour or their own salary or whatever it is. So that tends to designate employee. So risk of loss, that's on a contractor. Contractor brings their own tools. Integration, basically, how important is this person? The air conditioner contractors, he's important because you're hot. But as soon as he leaves, he's not important anymore, right? President of the company is important. And I continually use this example and this is real life. I have some, I won't name anybody, but clients from overseas. They had, I don't know, a dozen people working here in the US and they were all contractors. Even the president of the US company was a contractor. And we had several meetings trying to dissuade them from doing it that way. Obviously, we had to document every discussion so we didn't get in trouble. But they finally came around and hired employees. But that's an example of somebody is too important. They're tied closely with the integration of the company. And then the most important one is called control. Who has control? For the example of the air conditioner people, I don't know what they're doing. I just know they're fixing it and I don't mess with them. An employee, you say, okay, I want you here at 8 o'clock. Here's the software that we use. I want you to use this computer, this software. Here's the uniform. I want you to wear this uniform. You get so much vacation, so much this, so much that. All of that says employee. The more control you have over someone, the more that person leans towards employee. So like I said, it's not black and white. You look at a scale, you kind of tip the scale one way or the other. We encourage you to get with us or your attorney if you want somebody to be a contractor and not an employee. Don't make an arrangement with them until we get all this background set up, because we can, have them create a company. We can get them an EIN number. We can do various and sundry things to make them contractors, get an attorney to draft a contract. And we can do that. You just got to take your time, slow down and do it right. That's a big deal. We're going through it really, really fast, but we could talk about it for a whole hour, just this one subject. All right, here's something that I do not like these at all. They're all due in January pretty much, which we call the month from hell, because so much work has to be done in January. But 1099s, you guys have all heard what they are. You may or may not know who needs to get one or what you put on them. Let's talk about each one. There's a 1099 NEC, which stands for non-employee compensation. This is for contractors. So-and-so was a contractor. They did work for me. They charged me $1,000. That's more than $600. Therefore, I send them a 1099 NEC, which is for labor. There's also, this 1099 NEC is due to the contractor. I'm going to use the term contractor for a minute. And the copy to the IRS is due January 31st. There is a way to extend that, but it's not easy to find, but it can be done. Then there's a 1099 miscellaneous, which we use the term qualified vendor. This is not for labor. This is for rent. If you rent your office, you may or may not need to send a 1099 miscellaneous to your landlord. If you use an attorney, you need to send a 1099 to the attorney. Other income, prizes, you go on Prices Right and win a car, they're going to send you a 1099 prize for the value of that car, and you're going to have to pay tax on it. Healthcare is primarily doctors, nurses, counselors, that type of stuff. Their labor dollars are reported under a healthcare bucket. Fishing boat proceeds. The $600 doesn't necessarily apply here. It applies to most categories except for attorneys. And we like to poke the attorneys, and maybe they're big tax cheats is why the IRS says this. But if you pay an attorney, like $1, you need to send them a 1099. And this is business to business. So if you're getting a divorce, that's personal. You don't send a 1099 to an attorney doing your divorce. We're talking business to business. So the term qualified vendor means, do they qualify as somebody who gets one? And here's where it gets everything we do is complicated, but use a form W-9 to send to whoever somebody I think is a qualified vendor. I don't know. I pay my rent to my landlord, for example. I'm going to send my landlord a W-9. Landlord's going to fill it out and send it back. This form does not go to the IRS. It goes in your records. But it asks the landlord, what's the name of you or your company? What's your Social Security or your EIN? What type of entity are you? Okay, you're an LLC. How are you taxed? Are you taxed as a corporation? Are you taxed as a partnership, sole proprietor, whatever? All of that dictates to you whether you need to send them a 1099 or not. So if somebody you think is a qualified vendor is a corporation, SCorp or CCorp, you do not have to send them a 1099. But if they're a partnership, single owner LLC, then yes, you do. So you could have two people doing exactly the same thing. One of them you send a 1099 to, the other one you don't. It's strictly how they are set up. And you use that W-9 form to document when the IRS comes looking and says, why didn't you send one to Joe? And you say, well, Joe filled out this form, is her signature. He claimed he's a C Corp, and the IRS will go, okay, cool. And then they'll go after Joe if they don't think that's right. But you need to go through this process. If you start working with somebody, especially if you're in construction and different things, we see it all the time. We brought in the framers. Okay, they came in and framed a house, or they did whatever, but we only brought in, let's say, individuals instead of a framing company. Each individual you need to get a W-9 from, because you're going to need their Social Security number, you're going to need their name, etc., to send them a 1099. Well, if you don't get it up front, I guarantee you, you'll never see that framer. You probably never find that framer when it comes time to filing the 1099s. Therefore, you're in trouble because you can't file the 1099s because you don't have the correct information. So if you don't get the 1090 or the W-9 up front, in theory, you're supposed to withhold 28% of what you would be paying to an individual. Between you and me and the fence post and whoever's listening, I've never seen anybody actually do that, but that's what you're supposed to do. Withhold 28% and send it to the IRS. All right, we're running slow on time, so we're down to the last two slides, I think. Franchise tax, we've been talking about it. If you have a legal entity, an LLC, a CCorp, a limited partnership, trust, those type, I've seen trusts, some that were subject, some that were not, so you have to be careful. But you would need to file a franchise tax return. It is due to the Texas State Controller. It is due May the 15th, and you can extend it. If you can't get it done by then, you can extend it out till November the 15th. You can extend, when you file an extension, you're extending the filing, not the payment. So you need, if you owe money, you need to go ahead and pay it by May the 15th, or else you're going to pay some penalties. But the franchise tax is based upon the entity's gross revenue. And right now, if you are at 1.18 million gross revenue or less, or you're less than 1.18 million, you're not going to owe any franchise tax, but you still got to file the form. You fill in the form, here's my gross revenue, here's my officers, da-da-da. You sign it and send it in, and it does not take long at all to fill it out. If you're over the 1.18, it becomes a lot more complicated, especially if you're in multi-level partnerships and stuff like that. But generally, most of the small businesses are under that. You don't pay any, but you have to file it. If you don't file it, you're going to lose your legal protection that the entity creates for you. If you do owe, there's two rates, 0.75% if you're a non-retail or wholesale, and then you get a 50% discount off that if you are retail or wholesale. So you could be a wholesaler selling ice cream carts, because we've been on ice cream today. And then you qualify for the 3.75% or 0.375% rate. And it's based upon the NAICS codes and the SIC codes. So on this form, you got to put those codes if you want that rate, and you need to have the right codes to get the rate to calculate. So, but again, this is fairly easy. Just make sure you do it. Don't blow it off. If you don't do it, you're going to lose your company. You're going to lose your legal protection. There are ways to reinstate it. You have to come see us. We can get it reinstated, but it costs a lot of money. You got to pay back fees and fines to the state controller, but you can get it reset back up. But you can also lose your name. So if you got a really popular name, like Icky's Ice Cream, everybody wants Icky's Ice Cream. If we lose our legal protection with the controller, and then we lose it with the Secretary of State, somebody comes steal that name from us, we may not be able to get it back, but we could try. Okay, last slide, personal property tax. If you own a home, you know the process. You own a home, you get an appraisal every year. We appraised your house at X, you get sick, you go throw up in the trash can because you know your house is not worth that. You can go fight it if you want to, good luck. If you don't fight it, then in October-ish, you're going to get a bill for property taxes, which you have to pay around January. Personal property tax is the same type of a process, but it's for your business assets. It's for everything that's not real property. So when you think real property, think your house, your land, stuff like that. Personal property has nothing to do with personal or business. It's all business, but it's vehicles, machinery and equipment, computers, inventory, that type of stuff. And you get to pay this tax every single year over and over and over again on the same items. So there is a property tax rendition form that it typically is mailed out in January or February. If you register with the Secretary of State, they're going to notify the controller. They're going to notify the Bexar County Appraisal District who does this. And you'll probably get a property tax rendition to fill out. If you don't, you know, I'm not going to tell you not to file one, but sooner or later they're going to find you. So you might want to look into whether you really need to file one or not. Generally, if you got less than $20,000 in assets, they may just let you slide. They don't. If you're working out of your home office, a lot of times they kind of let you slide because it's not worth their effort. But once you get bigger, you need to pay more attention to this. So you get the property tax rendition. Who are you? What do you got? You put down, I bought a computer in 2021. I paid this. I've got, you put everything that you purchased down, plus it has stuff you previously had on prior returns. You know, you can, if you don't like filling out all that, you could just say everything I got's worth 20,000. You know, they may or may not accept that, but it's so you can try it. But you file this return. I believe it's due April the 1st. It's due in April. April's a blur to me. I don't know the 1st, the 15th. It's all a big blur, but sometime between then is when this rendition form is due to the appraisal district. In May, I believe it's in May, they send you a form. Here's what we've appraised your stuff at. Here's what it looks like your personal property taxes are going to be. You get a bill in October, you pay them in January, very similar to the real property taxes, just on the business personal property. And then the rates are not that huge. We pay $300-400 a year, so it's not a huge deal, but you don't want to ignore it. And if you got a lot of assets, trucks, machinery and equipment, inventory, then it becomes a much bigger deal. So that's it. Timing was almost perfect. We got 6 minutes left according to this. So we'll hang around and answer any questions. If you guys want a copy of this, I know it's being recorded, but if you want a copy of the presentation, email us at admin@PlemonCPA.com. You see it on the chart there, and just ask for a copy of the charts. If you want to sit down and meet with us, we have links to a calendar that you can just go on there and set up meetings at your convenience, however it works. And then check out our podcast. We really enjoy mentoring, teaching, coaching people. So we have a series of podcasts called The Hustle, Juggle, and Struggle of Small Business, where sometimes we talk, but majority we'll let our clients talk. And here's what we did. Here's what we went through. Here's how we solved this problem. A lot of great topics. I encourage you. You can get to some of them on our website. We're on, I don't know, YouTube and Apple and all of these places. I don't even know where they all are. Somebody has to go fetch them for me when I need one. But anyway, that's all I got. So I'll hang around here for a few minutes if there's anybody with questions.
I have a question.
Okay.
Hi, my name is Sandra. Thank you so much for the great presentation. A lot of useful information.
Good.
My question is, I work for a company. I receive a W-2, and I also run an Airbnb, which for the past 2 years I've filed together as my personal under my personal taxes. At the end of last year, 2021, I purchased a commercial building, and for that I created an entity, an LLC.
Okay.
Now my question to you is it possible to file my personal taxes with this LLC together because it's a single person LLC?
Yeah, it would be a single owner LLC. So if you don't want it to be taxed another way, it's going to default to being on your personal return. And then it would just be on the Schedule E for Edward. And that's where real estate goes.
Okay. And I've done a ton of renovations to this commercial property. Are those renovations deductible?
Yes and no. It depends on, if you put in an air conditioner system, for example, you can depreciate that. If you're building something that's structural, generally commercial property is a 39-year depreciation item. So some of the things that you build are going to improve the value or improve the life of the property. Then you may be looking at writing that off over 39 years, where an air conditioner, maybe you're looking at 15 years. You can break down some of the components and do that. But most of what you're talking about is probably going to be what we call capitalized and then depreciated or written off over a number of years.
Okay, and so would it be more advisable to meet with someone to talk about this at length?
I think so. I mean, if it's really complicated, then there are companies that actually do this and they break out buildings but they charge a lot of money, and they generally say you need, a building of 5 million or more before their fees start to justify themselves. But in general, we'd be happy to sit down and talk to you about what we give you some of our opinions of what we think could go in each category.
Yeah, I think that would be very helpful.
Okay.
And you said just go to the link.
Go to the link on the, yeah.
Okay, great. Thank you.
And you can also just go to our website at PlymouthCPA.com and click on Let's Meet. That gets you to the link also.
Okay, great. Thank you. I'll do that.
Look forward to it.
And I did share the email, the admin email, and
Okay.
the website on the chat, both on here and on Facebook, so you guys can reach out to David and his team if you have any other further questions. I don't know if there's any other questions from the group that we have right now that you would like to address. One more minute.
1 minute for $5.
I guess not. I'm gonna stop the recording.